Welcome back, traders, to chapter 3. I hope you enjoyed chapter 2 and you managed to understand the points that we're trying to convey. So, in chapter 3, we're going to be talking about players in the Forex market, types of analysis, and price charts. So, let's do it. So, first, let's talk about the biggest players in the Forex market. We have placed them in an order of their effect in the Forex markets, generally speaking, but it doesn't mean the order always appears like this on a daily basis. It doesn't necessarily mean that. And I hope you understand what I mean by that. So first we've got the super banks. So these large banks, collectively known as the interbank market, take on a ridiculous amount of forex transactions each day for both their customers and themselves. So if you can think of banks like Citibank, Goldman Sachs, Bank of America, JP Morgan, these are some of the huge banks and they effect large transactions on nearly a daily basis. So because of the amounts they trade, they may end up causing market movements. So for that reason, they may be called market makers. All right. So if a bank like Goldman Sachs, if you try to think of the amount of money that they may have under management or under their facilities or that's at their disposal for speculation, these are large sums of money, and because of that, they may end up in situations where when they buy something because of the sheer value that they buy, that thing may appreciate whatever instrument that we may be talking about. So our job, particularly with our strategy here at Atlantic's Academy, we are simply trying to anticipate the move that the large bank is going to make. Because if they make a move and we can anticipate that move beforehand, we're able to profit from their decision in the market and make money when the market moves in our direction or the bank's direction, whichever you want to call it. Second, we've got large commercial companies. So these are companies that take part in the foreign exchange market for the purpose of doing business. You may find companies like Apple that are buying parts maybe from China, Amazon that may be buying goods for resale from India, from China as well, wherever. I'm sure you can appreciate when they're buying these kind of things from abroad, the kind of money that's exchanging hands from a American business to the hands of a Chinese business will be large sums of money. So these can also have a large effect on the forex market and the rate. And then you can talk also about mergers and acquisitions. Tata buying Land Rover. Hypothetically speaking, think of a scenario where a company such as Apple may end up being in a position to buy Samsung. The value of such a transaction will be huge, and the kind of monies that will be exchanging hands, possibly from country to country, will also be huge. Then you also have governments and central banks. These guys can affect the rate in the forex market through policy. Think of inflation. You think of your interest rate decisions and international trade payments, among um, uh, many other pieces of news that can affect the forex market. You also have the speculators. So basically, these speculators are in the act of buying and holding if they believe that a currency will appreciate in value, or maybe they sell a particular currency pair if they believe the pair will depreciate in value, but the hopes are that that change in the future will help them to achieve a profit. So let's talk about types of analysis in the market. So first we've got technical analysis. So this is a framework in which traders study price movement. Okay, the theory is that a person can look at historical price movements and determine the current trading conditions and potential price movement. Technical analysts use charts because they are the easiest way to visualize historical data. So that's why you may hear of technical analysts being called chartists, because they live, eat, and breathe charts. And this is typically what we do here at Atlantic's Academy. We are technical analysts, all right? We may here and there incorporate a bit of the fundamentals, but basically we are hard bound to technical analysis, all right? Fundamental analysis is a way of looking at the forex market by analyzing economic, social, and political forces that may affect currency prices. The idea behind this type of analysis is that if a country's current and future economic outlook is good, its currency should strengthen and vice versa. Meaning, if the outlook is also bad, then the currency should weaken. Okay? So you will find that fundamental analysts are the more common analysts when it comes to trading larger sums of capital, because now they strongly believe in the cause and effect relationship between economics and politics towards the value of an instrument. All right. This is what they're trying to do. They're trying to determine whether the political, social, and political forces at play, sorry, the political, social, and economic policies, forces at play will cause a instrument to rise up in value or to drop in value. That's what they're simply trying to determine. All right. They may incorporate technical analysis into the mix, but generally they're trying to analyze what's happening on the ground so that they can predict what's going to happen in the near and further future. Okay. Then we've got what we call sentiment analysis, and it's used to gauge how other traders feel about a particular currency pair. One idea behind this is if everyone or almost everyone shares the same sentiment, then it's time to go against the popular sentiment because most traders lose money. Now, if you haven't heard of it, there's some statistics that are normally touted in the Forex and trading industry. Basically, you hear people say 90% of traders lose 90% of their capital within 90 days or within their first 90 days, whatever it is. And this statistic basically speaks to the fact that most people are not profitable. Okay. You also hear stats that say 95% of traders lose money in the Forex market or trading indices or whatever it is. So it's a very, very difficult industry, and most people are suffering losses. And therefore, the idea that some of these sentiment analysts may adopt is that if we go against everyone, we're likely to make money. I'm sure it's not as easy. I'm not a sentiment trader myself, and I haven't made the effort to research deeper into that. But I believe it's more complicated than that, and they also have their methods of analyzing where price is going to go, etc., so that they have an edge and they can make money in the market. All right. So let's talk a little more about technical analysis because that's what we are all about this side, about analyzing what the historical data is saying and how it may have an effect in the future. So first, we've got what is called a line chart. A line chart is simply a chart that displays um, price or price changes against time, and the instrument used to depict that is a line. Okay, so if you can look over here on this slide, you can see that to the far left we've got the 15th of June to the 24th of December 2018, and the line is simply showing the price changes. If you look to the top left, you can see it says GBP USD daily. All right, so it's pretty much showing the price changes over a daily basis. Okay, it doesn't get any simpler than this. The only problem with this is there isn't too much information. What you can see, of course, is overall price has been going down or it's been bearish, whatever you'd like to call it. But in essence, it's difficult to properly get more details in terms of what actually happened on the 10th of August. What's happening today on the 24th of December? Is price going to continue to go higher? Is it going to turn and go lower? It's a bit difficult to get that. So for that, most people would then try and find other ways to extract more information from the line chart. Enter the bar chart. Right. If you first look to the right, you may see that the movements of the combined bar charts look like a line chart. But when you look closely, you then realize the bar is saying more information in itself. So the bar may represent a particular time frame. If we're going to say this was a daily time frame, as with the previous line chart, then every bar would represent a day. Now, taking a closer look at a bar, which is on the left side, you'll see that each bar shows the opening price, the closing price, the low of that bar time frame, and the highest price of that bar time frame. So if we're going to assume that this was a daily chart on the right, it means every bar represents a day. So on the left, you would have the highest price of that day, the lowest price of that day, the price at the open or start of that day, and the closing price or the price at the end of that day. So now we've got more information because from what we can see on every bar chart, when we see price going down, we can start to see whether the gap between when price opened or price closed is huge or small. And this can begin to tell us whether there was overwhelming selling momentum or overwhelming buying momentum. It can also tell us in days where the battle between buyers and sellers is not producing much of a winner, such that the price is moving sideways on a daily basis. Okay, I hope that's clear. Right. Others then prefer what is called a candlestick chart. Now, if you look on the top left or the first picture on our left side, you can see what are called candlesticks. First, on the left, we've got what's called a bullish candlestick, which is depicted as green, and it also shows the lowest price, the opening price, the closing price, and the highest price of a session. And then we've got what's called a bearish candlestick, which is a candlestick that's going down. Again, also showing the open, the close, the high, and the low. All right. If you look at the bottom right, you can see what a candlestick chart looks like. It's a series of bullish and bearish candles. Now, if you can look from the left to your right, you can see that you now have more information about what's happening on a daily basis. The top left of that picture shows British pound to Canadian dollar, or GBP CAD, 1D, which is for 1 day, or to say each candlestick or Japanese candlestick represents 1 day. I hope that's clear enough. So it shows the opening price, the closing price, the highest and the lowest prices of that particular day. I hope that's clear enough. All right. Now we've got more information because we can be able to know when price is falling by that red momentum, and we can see when price is rising by that green momentum or the green candles. Okay. So this is pretty much the kind or the three common charts that we see when it comes to technical analysis. As for us, we're going to be focusing more on candlestick charts because we can derive a lot more. It's easier to derive a lot of information from these Japanese candlesticks. And we're going to be talking about what what you can learn from candlestick patterns or a series of candlesticks. Okay. Now, if you look at the cheat sheet here, which we sourced from Binance Academy, you can see that we can interpret what is happening in the market based on the behavior or what we see from these candles. Okay. So first we've got what we call the hammer. I'm starting from the top left. And you can see that it's got what we call a longer wick. The wick of the candle is the part of the candle which is between the high or the low and the close and the open. I hope that's clear. Or to make it simple, if we focus on the basics that are at the bottom left, you will see that we've got what is called the high and the open. The part between the high and the open is what we call a candlestick wick. The part that's between the close and the low can also be called a candlestick wick or a shadow. All right. So we've got the lower shadow, we've got the upper shadow here. The same applies with the bullish candle, which is green. We've got the upper shadow or upper wick and the lower shadow or lower wick. So coming back to the one candle patterns, you'll find we've got what's called a hammer. It's got a longer wick to the bottom and a smaller body. All right. And then we've got what's called an inverted hammer, which is simply a hammer, but the wick is on the top. A dragonfly, which is a long wick and a very tiny body, often depicted with an open and a closed price that are in the same place. All right. And you also have your bullish spinning top, your hanging man, a shooting star, which would be a bearish version of an inverted hammer. And then you've got what we call a gravestone doji, which is the opposite of a dragonfly doji. And then we've got what's called a bearish spinning top. Now, if you look at all these candlesticks, what's important is not for you to know them by name. But what is important is to be able to derive the meaning from these candlesticks. All right. So if you have, for instance, what's called a bullish spinning top, what it shows you is that there's been an open and a close that are very close together. Meaning, during the session that is represented by that candlestick, the battle between the bulls and bears did not show us any clear direction as to whether it wants to go up or down. But we can see that the bulls just edged the bears marginally. All right. The same is true for the bearish spinning top, which shows that the bears edged the bulls just marginally. But the fight between them is almost equal, all right? But when you look at candlesticks, like in the neutral section, we've got that doji, or what I think or believe is pronounced maribotsu. It's a Japanese term, if I'm not mistaken. You can see now that those candles show proper indecision. You can't tell whether it's the bulls or the bears that are actually winning. It may be red, it may be green, but it's not enough for you to say the bulls are in control. All right? And for the doji, that's perfect indecision. At the end of the candlestick session, both the bulls and the bears couldn't decide whether the price was going to go up or down. All right? And then we have what's called, on the two candlestick patterns, engulfing patterns. These basically show a candlestick, the second candlestick, which is larger than the bullish candlestick. So if we were to see a smaller candle, as with the bullish engulfing, with a smaller bearish candle, and a larger or engulfing bullish candle, what that then illustrates to us is that we have got bullish momentum that's just formed. And in the session that's represented by these two candles, the bulls have overwhelmingly overcome the bears. So it's not just about knowing a pattern and seeing it and saying, this is a bullish engulfing pattern. No. But it's about understanding what the pattern actually means. What does it mean to you? What does the pattern illustrate? And how can you interpret that pattern so that you know what's going to take place in the market? All right. So I encourage you to take time and study these candlestick patterns, not because you want to know the terms, like I said, but because you want to understand them. And what is critical, what I believe is critical, is an understanding of how to apply them. All right. So we won't be heavily focused on using candlesticks in our strategy per se, but having them will really help you to understand and interpret what is taking place at that particular time. And I will show you how in our technical analysis session. All right. And then lastly, we're going to be talking about chart patterns. Now, these are shown in linear format, but these lines are simply meant to be showing a series of candlesticks, all right, on a chart. Again, this is important material for you to know, although we don't necessarily use it as heavily, all right? So we've got what's called a symmetrical triangle, an ascending triangle, an inverse head and shoulders, and we've got a cup and handle, falling wedge. All these chart patterns have got a direction that they anticipated to move into. So, for example, generally when it says a continuation pattern, it simply means when you see this pattern form, or when you see a series of candles that creates a pattern that looks like a symmetrical triangle, chances are price is going to continue to move in the bullish direction. All right, as you can see on the first chart pattern here of the bullish symmetrical triangle. So again, I'm not going to go through all of them because we've covered quite a lot of content and this video would be quite long. Additionally, we are not heavily biased towards trading Forex chart patterns, but these are important basics for you to have. So I would encourage you to study these chart patterns and understand how they work, so that when we come back in the next session where we're going to be talking about technicals, you're going to have a full understanding of how we incorporate or how we don't incorporate these chart patterns. Otherwise, I hope that you have managed to learn a lot from this last session, which I believe was simple and straight to the point. In our next session, we're going to be going through the technicals more. So be ready for that. I'm sure that's the part that everybody wants to be talking about, where we talk about how we actually make money from the market. So otherwise, enjoy and get a refreshment or whatever. See you in the next section. Cheers.